Happy New Year, Pure investors. I'm Nick, and this is your December update for the Pure Income and Growth Fund. The fund grew 1% in December, underpinned by strong performances in XREF, up 11.5%, CarbonXT, up 11%, and Sincera, 15%, with other positions across the portfolio broadly flat. During the month, we converted 20% of our warrant exposure in XREF, purchasing equity at 35 cents per share. With the stock trading around 70 cents per share, XREF has delivered an approximate 100% equity return for the fund in 18 months, as well as 10% per annum interest during that period. We continue to think XREF is undervalued and are excited about the company's prospects in calendar 22. The warrant exercise proceeds provide management with additional marketing cash flow, which we hope can accelerate XREF's growth profile off of an already impressive base. Also worthy of mention this month is Decmil, which announced in the first week of January a successful conclusion to operational testing of its Sunraysia solar farm project. For those investors not following Decmil, Sunraysia was the final problem child of prior Decmil management to be cleaned up, and a potentially significant draw on cash flow were the project not to be completed successfully. However, with the project now completed successfully, the risk for a significant draw on cash flow is removed, and management can focus on the execution of what we'll dub New Decmil. Whilst we're not naive enough to think it will all be smooth sailing from here, Decmil is, after all, a contracting business. We've been nothing short of impressed with execution by new management since providing our funding facility in the second half of last year. We believe that once Decmil can demonstrate new management is executing on work in hand profitably, that the stock is come a substantial re-rating, and as such, we look forward to the February results update. This month, we explore how distributions work in the fund. In the Pure Income and Growth Fund, distributions are paid quarterly. Each quarterly distribution can consist of interest income from outstanding corporate loans, realised capital gains, and fees and charges charged to companies for loan establishment. Whilst the flow of interest income is relatively consistent quarter to quarter, fee income and capital gains contributions will vary, and as such, you shouldn't expect a linear progression in distributions from quarter to quarter. Further, while capital gains can be realised at any point during the year, we are more likely to distribute them in the second half of the year, ensuring the fund doesn't inadvertently over-distribute at any point during the year, which could then impact on the subsequent year's distributions. In any given quarter, the cents per unit distribution is determined by the cash available for distribution and the number of units on issue. As a rough rule of thumb, you can estimate at the start of the financial year the cents per unit you could expect to receive by the end of the financial year should the fund meet its target of a 7.5% per annum distribution return. You can do this by taking the value of your investment in the fund, multiplying it by 7.5%, and dividing it by the number of units you held in the fund at the start of the year. Please note that this is just a rough guide and will be impacted by several factors, including the number of new units issued during the year, the composition of the portfolio through the year, where, for example, a higher cash balance dilutes the portfolio yield, and vice versa, and finally, fees and capital gains realised during the period relative to the prior year. Over the past 2 years and in the last 6 months, the fund has adopted a conservative cash stance, carrying a higher cash balance relative to its target of 10 to 15%. Of late, however, this has reduced, following several deployments in December and early January, and we expect the cash dilution of yield to be meaningfully lower in the second half of F22 than the first. Thanks for your time, and we look forward to updating you again in February.